very well, my dear students, that is, under direct taxation, you will have total five heads of income. That is income from salary, income from house property, income from profits and gains from business and profession, income from capital gain, as well as income from other sources. Now, these are all under direct taxation part. So, in our today's class, that is our today's topic of discussion in this segment, that is income from house property. So, now, as income from house property, that is, there are several income tax abbreviations. The first is the assessing officer, that is we termed as a AO. Second is the actual rent, that the rent is actually being accounted for, that is there is a landlord and tenant, and the tenant has to pay rent to the landlord regarding the one taxation area. Next is the assessment year. Next is the certificate of completion. Now this certificate of completion we need to have, that is when you are supposed to calculate income from house property under the interest on loan section. Next is the expected rent, that is we termed as a year. Next is the fair rent, that is FR. Now that what is fair rent we will come in our later on, that all the abbreviations we will discuss in our later side, but this abbreviation we need to follow when we are moving to a sum and the several types of the lecture. Next is the financial year, that is F5. Now the next is the gross annual value, that is we are termed as GAV. Next is the IFHP, that is your income from house property. IFOS, that is income from other sources. Next is the municipal value, that is called MV. Profits and gains from business and profession, that is called BGPP. And the rule we are specifically followed in income tax rule 1961. But the thing is that from this year and onwards, we are moving to the direct taxation code, that is Income Tax Act 2005, and that the Income Tax Act 2025, and the Income Tax of 1961 will be replaced by the Income Tax Act 2025, and the SR is the standard rate. Now, this abbreviation in my lecture we used to follow when we are supposed to solve out the sum as well as the various type of the series. Now, next is the introduction to income from house property. That what we are going to study under this lecture session, so that we can say that we are actually framing a legal framework for taxing on house property of the following sections. That we are supposed to do the definition of annual value, which is covered under section 2 subsection 2 of Income Tax Act. Second is the section 22, that is called the chargeability. Second is the section 23, that is the computation of the annual value. Section 24, that is the deduction available. Section 25 AA, that is the collection of unrealized rent, which has been introduced in 2001 to financial year onwards. Next is the section 26, that is the property owned by the co-owner. Now that who is a co-owner, or that what are the relevant provisions regarding the co-owner, we will see in the later on. And next is the section 27, that is called deemed owner. Now the deemed owner concept is actually being when the house property is transferred in favor of some person, and that this is not considered as an adequate consideration, right? So that it is called the deemed owner. Now next is the key definitions and terminology. So that in our house property section, that is house property means it includes any type of building, any type of apartment, or that land which is actually built up with an apartment, that is called the interconnected area. Building means that is including the residential house, including the various type of office, including the various type of go down shop, that is the factory, etc. But in some cases there are some exceptions. Now that what are the exception we will see in the later on. Next is the land apartment, that is land it connected to the building, that is garden, garage, parking area. Next is the fair rent. Now, as you see, that fair rent is something that is rent of a similar property in the same locality that will be fetching up by an individual. For example, suppose I have one house in Kolkata area. Suppose in Kolkata in a particular area. Now the fair rent is actually in that particular area. What is the expected, or that what will be the square foot area of rent? This is actually the same locality value. That is in my flat, or that in my house will be considered in a same locality, and the second one. Next is the municipal value. Now the municipal value, the value has been adopted by municipal authority for levying taxes for their property tax valuation, right? Next is the standard rent, that is the maximum rent fetched by the Rent Control Act, and this Rent Control Act will be active for 1948. Next is the arrears of rent. Arrears of rent means that is rent outstanding from the tenant, or the often due to rental agreement valuation. Now, when I am talking about that landlord and tenant relationship, so that obviously there will be a question of rent received by a landlord from the tenant. Now, if there is any unpaid amount, I repeat this, if there is any unpaid amount which is not supposed to received by landlord, now this is called arrears of rent or the outstanding rent. Now, this is something different of the unrealized rent, right? So unrealized rent means that is rent cannot be collected. Now there will be a difference. Arrears means that is rent is outstanding for landlord. It can including some vacant area spaces. But when I am talking about the unrealized rent, that is rent cannot be recovered, but the landlord has to stay on that area or in that month on the inside the house. So that we can say that the areas of rent is a slight or marginally difference with the unrealized rent. Next is the impartial estate. Now, this property is legally indivisible. Now, that what is the impartial estate? It will connect it to the various, or the various or the several provisions of the Income Tax Act. Next is the tax levied by authority. Now, the authority, that is the municipal corporation. It is about the property tax. It may be the water charges. It may be the fire. It may be the various type of provisions that is under the municipal authority. And next is the composite rent, that is total rent has been received for the property plus the other amenity of feature or the security. So these are the various key definitions and terminology that we are going to use under income from house property. So that this is actually the basic thing or the basic background information of house property, which will be very useful regarding our lecture of the today's lecture session. So first thing is the basis of charge, that is under section 22. Now for income to be taxable under this head, the three conditions must be met. Now that your question probably, sir, what are the three conditions? The conditions say that it must be consisted at building a land apartment and thereon. So that a this can be a building, this can be a apartment, that is the construction form. If it is not in a construction form, it cannot be determined as a house property income or that the house property segment. Second is the ownership. Now the thing is that the assessee must be the legal owner of this property. Now, in this ownership concept, there are several types of ownership. One is called the original owner, second is called the partial owner, third is called the co-owner, fourth is called the deemed to be ownership. So that there are various type of ownership, but ownership must have to be the legal position under the name of the assessee. And the usage of the house property, that is it should not be used at the owner's business or profession. So that this house cannot be used as a owner's business or profession. Now my dear students, please do highlight this word, that is owner's business or profession. Please do now that what is the owner's business or profession? Now that what is the owner's business or profession? Now this owner's of business or profession means, suppose the house property has been used by the owner for his original business, or if the house property is used by the owner for the delivering of consultancy services. Now, this terminology will not be highlighted under income from house property. It is solely under the residential purpose of the owner, that is called self-occupied, or it will be give out to the let out purpose. So that under any form of business or profession, it cannot be done. Next is the concept of the annual value. So, income is not charged on the actual profit but on the annual value. Now, that again, there are three things. What are they? Annual value represents the inherent capacity of a property to earn income. Second is it is the amount for which property may not be reasonably expect let out from 1 year to year. Now for this year it has been let out, but for the next year it is not mandatory that the let out provision will be applied. It may be the self occupied, that is the ownership own residential purpose, and it includes land or building excluding properties used for the owner's business. Now, computation of income from house property. Actually, I am trying to highlight that what is going to important in this area. Now, first is the gross annual value. Now, what is the gross annual value? So, gross annual value is nothing but that when you are calculating the gross annual value, it is an higher of municipal value and fair rent but restricted to standard rate. And then after that we will move on, that is rent has actually been received as well as the expected rent which is to be higher. Now this gross annual value calculation, it is it will see in our later slide, but after calculating the expected rent we are need to calculate that is what will be the annual realizable value, and that the higher of expected rent and the annual realizable rent, it will be termed as a gross annual value. So from this gross annual value we are supposed to deduct the municipal taxes, and and that please do note this word, that is paid by owner only. So that municipal tax, if it is paid by owner, then it is considered as a subsequent deduction from the gross annual value. But when I am talking about the municipal tax paid by tenant, it will not be considered under the gross annual value, that is subsequent deduction under income from house property. So that only municipal tax paid by owner will be considered here. So that after this deduction we will get the net annual value, and from this net annual value we will deduct two subsequent portion, that is under section 24 of income tax act, that is the standard deduction. So this standard deduction first is the 30% of net annual value, that what will be the net annual value we are going to derive here. So that this 30% of this net annual value, and second is the interest on borrowed capital. Now it is under section 24b. Now the what are the provision under interest on borrowed capital we will see in our later slide, but for now your understanding, that is interest on borrowed capital, that is loan taken from house property, right? That is loan taken from house property. So that this is called under interest on borrowed capital. Now the second thing is that is the from the net annual value we will get the subsequent of the two deduction, that is under section 24a and the 24b, and then we will move on to the net income from house property. Now the second thing is that is the let out property, that is property rented out to the tenant. This is number one, that is called the landlord and tenant relationship. Second is the self-occupied house property, that is property is used by the owner for his own residence. And the deemed to be let out, that is property owned by the assessee, that is legally to be treated as a rented position. Now that what is the deemed to be later, we will also see in our later slide, right? Now the next thing is that is uh, principles of determining of the net annual value. So first is the actual letting is not mandatory for the net annual value. Now in this case, suppose if we are talking about the let out property, then there is a relationship, that is a rental relationship in between landlord and tenant. Second is the reasonable return may differ for the actual realizable rent received. Now how to calculate this actual realizable rent, we will see in the later part. But the thing is that the reasonable return may be differed of the actual realizable rent received. Second is the higher value of rule. That is, if the actual rent is higher than the reasonable return, then it is called the actual realizable rent has been used under income from house property. Second is the reasonable rent rule, that the if the actual rent is lower than the reasonable rent, then it will be considered as the income from house property will be a later part, that is the expected rent. So that this has been the indicator, that is municipal value, cost of construction, standard rate, as well as all the benchmark. Now as we have already discussed, that is step by step calculation of the gross annual value. So that as you can see, that is step number one, you will first find the expected rent. Now that what is expected rent, that is the municipal value as well as fair rent, whichever is higher but restricted to standard rent. So that this is called expected realizable rent, that is called ERR, or sometimes it has been called ER. That is the fair rent and municipal value, whichever is higher but restricted to standard rent. Next is the actual rent. Now that what is the actual rent, that is rent will be receivable, that is annual realizable rent minus unrealized rent. Now that what is unrealized rent, just we have discussed, that is unrealized rent means that is rent has not been recovered from the tenant when we are calculating income from house property. So that actual rent means that is the annual realizable rent minus unrealized rent. Now step number three is compare, that is higher of step one and higher of step two. So that from the higher of step one and step two, whatever be the value, so that it will be considered as a step number three. So that either expected rent is greater than the actual rent, or sometimes the actual rent is greater than the expected rent. Then number four, this is called the loss due to vacancy. So that if there is any vacancy, that is lock and key situation in case of ownership or tenant, that is the house had not been used under the self-occupied portion or the let out portion, then the vacancy period will be deducted. And then after computing vacancy, we will see the gross annual value, that is from step 4, from step 3, that is the step 4 minus step 3, that we will see the gross annual value. Now this is actually the pictorial form. Whatever be the gross annual value, just we have calculated under the theoretical portion. Now this is the pictorial form, right? So first you can see that the let out throughout the year, that is there is no vacancy period. I am repeating this just once again, that is laid out throughout the year, there is no vacancy, there is no unrealized rent. So higher of expected rent and the annual or actual rent received. So that expected rent is the higher of municipal value and fair rent, just we have discussed, but limited to standard rent. So that this is the first condition, right? If we move on to the second condition, that is let out but vacancy a part of the year, that means the house has been used for the let out purpose, but in some months it will be the vacant for the lock and key situation, that is neither ownership, that is neither owner nor tenant inside in the house. So that in that case the gross annual value is higher of expected rent and actual rent received, because when we are talking about vacancy, right, that when we are talking about vacancy, that is our expected rent, that is what will be my expected rent it is ultimately derived from, that is it is ultimately derived from the vacancy period, right? So that if my vacancy period, suppose if my vacancy period is 3 months, so that expected rent minus 3 months, so that we will see that is the gross annual value, right? Next is the self-occupied position. Now that under self-occupied position, you will see the gross annual value is nil, and that obviously the net annual value is nil because there is no municipal taxation benefit. And the next is the no deduction allowed for the municipal taxes. And the let out part or the self-occupied part, that is the gross annual value is higher of expected rent as well as the annual rent receipt. Now it will be clear when we are supposed to do sums on income from house property, right? So the first illustration, that is computation of gross annual value. I hope up to this it has been clear to the all of you, my dear students. So now we are moving to income from house property, that is the computation part, that is the first illustration. Problem statement. Now that what is the problem statement? Mr. D owns two houses. House number 1 remained vacant for 4 months and house number 2 was vacant for 3 months. So compute gross annual value for both the houses for the assessment year 1920 with the given. Now this assessment here I have taken because there are some changing of rule after this, but in this case that your but in this case your assessment year maybe 2024-25, maybe it is 25-26, right? So the thing is that that is the house number 1, you can see the municipal value that is 90,000, and that the house number 2 is the municipal value is 55,000. Fair rent is 75,000, as well as the house number 2 fair rent is 65,000. Standard rent is 85,000 and the standard rate is not applicable under house number 2. And the actual rent, that is called actual rent received. Now what is this actual rent meaning? That is the gross annual, that is the total expected rent minus the vacancy period, right? So that actual rate in case of house number 1 it is 80,000 and that house number 2 it is 45,000. Now this additional information just we are receiving, that is actual rent received. For house number 1 it will be 8 months and for house number 2 it will be 9 months. So that in our total area, or that the total months in a one particular financial year is 12 months. So that out of 12 months, that the house number 1, that is actual rent, it is for 8 months and that it is for 9 months, right? So I hope the sum is clear up to this. Now we are moving to the solution. You see the solution and in a very step by step. So step by step computation of the gross annual value. So that you can see the house number 1. So municipal value it is 90,000 and fair rent it is 75,000. So just we remember the rule, that is fair rent or municipal value whichever is higher. So that you can see the fair rent and municipal value whichever is higher. I am talking only house number 1. House number 2 we will see in the later on. So my fair rent is 90. My fair rent is 75,000, and my municipal value is 90,000. So fair rent or municipal value whichever is higher. So that this is my step number 1 for computing gross annual value, right? Now fair rent or municipal value whichever is higher, but there is one provision. It is called standard rate. So fair rent or municipal value whichever is higher but restricted to standard rent. Now you can see what is the restriction. It is 85,000. My standard rent is 85,000. So we are taking this 90,000 along with this 85,000. Just we are considering 90,000 and this 85,000. So that whichever is lower, that is 85,000. So that we can say that actual or that the expected realizable rent is 85,000. As you can see in our working note, just I am showing working note here, that is our expected rent is 85,000 in case of house number 1. Now coming back to the house number 2 up to this step, you can see the fair rent is 65,000. You can see the fair rent is 65,000 as well as the municipal value is 55,000. So that fair rent or municipal value, whichever is higher, that is called 65,000. But there is no restriction of standard rent, because the standard rent is not applicable for this portion. So that if the standard rent is not applicable, so this 65,000 will be considered as an expected rent value. So that just you can see that the house number 2, that is the 65,000, that is higher of municipal value and fair rate, because there is no restriction in case of the standard rate. Now that if there is any standard rate, so that we will obviously follow, that is fair rent and municipal value, whichever is higher, but restricted to standard rent position. So I hope up to this it is clear. Now we move on to the step number 6. That is in our step number 6, that is called actual rent received. Now this actual rent received, there will be some calculation. You see the house number 1, it is 80,000, but please to remember, you see the step number 2 under working notes, this is for 8 months rent. You can see once again, that is house number 1, in case of actual rent received, it is for 8 months, right? So that when I am talking about the 8 months, so obviously what will be the monthly rent? That is rupees 80,000 divided by 8. So that I am trying to show that how to calculate annual realizable rent, right? So that first of all you need to calculate monthly rent. So that how to calculate monthly rent? That is your annual or expected or that actual rent received is your 80,000. Now 80,000 for 8 months, so just an unitary method. So if 80,000 for 8 months, so that 1 month will be 80,000 divided by 8, that is rupees 10,000. Now in similar case for house number 2, just I am comparing in between two houses. Now in house number 2, you can see actual rent is 45,000. If you see the question, that is house number 2 actual rent received 45,000, and that it is for 9 months calculation. So that when I am talking about this 9-month calculation, that is this 45,000 is about to 9 months realizable rate. So that what will be the monthly value? The monthly value is 45,000 by 9, that is rupees 5,000 per month. Now we are getting monthly rent. Now after that, see the working note number 4, that is the potential annual rent or the annual realizable rent. Now that what is the value? That is 1,20,000. How to compute this 1,20,000? So in a one particular financial year, it will be 12 months. If 10,000 per month, so the 10,000 into 12, that is rupees 1,20,000. In a second house, that is it is 60,000. How the 60,000? It is 5,000 per month. So 5,000 into 12, that is rupees 60,000, right? Now that what is the comparison? Just I am moving step by step. What I have discussed theoretical value, this is just the practical. So the potential rent, that is 1,20,000, which is greater than 85, so that it will be a higher value, that is rupees 1,20,000, right? Second case, the potential rent or the annual realizable rent, it is 60,000, and that the expected rent, it is 65,000. So 60,000 less than 65,000. Now why the shortfall? Because the shortfall due to vacancy. Because we know that in a house number 1, the vacancy period is 4 months. In case of house number 1, the vacancy period is 4 months. How to calculate this 4 months? Because the total is 12 months, expected rent is for the 8 months, so the remaining is 4 months. And in house number 2, vacancy period is 3 months, so the total is 12, and the 12 minus 9, that is 3 months. So that after computation this vacancy, you can see the legal provision under section 23 subsection 1 clause C, that if ARR is lower than ER, that is if annual realizable rent is lower than the expected rent due to vacancy, then ARR will be considered as a gross annual value. So that what does it mean? If annual realizable rent is lower than the expected rent due to vacancy, then gross annual value will be calculated as ARR. So that as you can see, our potential rent for house number 1 is 1 lakh 20. So 1 lakh 20 and 85,000, whichever is higher, that is 1 lakh 20,000. So from this 1 lakh 20,000, you need to vacancy period, that is subsequent deduction. There is a vacancy of 4 months, so that our 10,000 is the monthly rent. So 10,000 into 4, that is 40,000. So 1 lakh 20 minus 40, it will be considered as an 80,000, right? So that you will see our gross annual value is 80,000. I repeat this once again, this calculation. Our our expected rent is 85,000, right? And our potential, that is annual realizable rent, is 1 lakh 20. So 1 lakh 20 and 80, whichever is higher, that is rupees 1 lakh 20. So from this 1 lakh 20, you need to deduct vacancy period. Now that what is the vacancy period calculation? The house number 1 is still remain vacant for 4 months. If 1 month rent is 10,000, so that what will be the 4 months rent? It is 40,000. So that 1 lakh 20 value minus 40, whichever is lower, that is 80,000. So this 80,000 we need to calculate, that is under the gross annual value in case of house number 1. In similar way, we need to calculate, that is house number 2. Now this house number 2, you can see the point number 6 under working note. The rent is naturally lower than the market value, plus there is a vacancy. Now you can see that fair rent or municipal value, whichever is higher but restricted to standard rate, it will be 65,000. So from this 65,000, you need to deduct vacancy period. So that what is the vacancy period of house number 2? It is actually 3 months, right? And these 3 months will need to deduct, that is, if the 5,000 is per month rent. So if there is a 5,000 per month the annual rent, so 5,000 into 3, that is 15,000. So 65,000 minus 15,000, and that after that it will compute the gross annual value of rupees 45,000. So that in this way we can see that the vacancy period calculation. I hope up to this it is clear. So now we are moving deduction from the net annual value, right? So the net annual value of the property subject to two primary deduction depending of the property use. So from this gross annual value, we need to calculate the municipal taxes. After deduction of municipal taxes, we will calculate the net annual value. So the first deduction is, that is the section 24A, that is the 30% of NAV, just we have discussed. Second is the interest on borrowed capital under 24B, that is the interest paid on the loan taken from property fully allowed without any upper limit, but the upper limit subject to maximum of rupees 2 lakh, but there is some provision we will see in the later on. Now there are two types of property as we have discussed in our previous slides, that is the self-occupied property as well as the let out property. So that when we are talking about the self-occupied property, there are two types of valuation. Now see, if your loan, or that if you have taken loan before 1499, please do remember these two dates, my dear students. So that if you have taken loan before 1499 for the purpose of construction of the house as well as for the purpose of renewal or repair of the house. Now there is a difference in between construction, renewal and the repair. Suppose if you are supposed to do in your house, that is paint or several type of repair in this case, so that you will get maximum 30,000 if your loan is before 1499. But at the same time, if you have loan taken before 1499 and your house is being constructed or that loan has been used for the purpose of renewal or the reconstruction basis, so the maximum amount is rupees 30,000 again in case of 1499. So the just a precautionary made, that is the before 1499, if you have taken your loan for the income from house property, if your intention of using of loan it is repair, renovation, construction, renewal, whatever it may be, you will get maximum 30,000 of interest benefit. Now, my dear students, here I am uttering this word, that is interest, not principal, because the principal amount subsequent deduction we will follow under section deduction chapter, that is deduction under section chapter 6a. That is actually for the principal amount of the house property. Here we are only considering under section 24b, that is the interest on borrowing loan. That is, if you have taken loan before 1499, that is your maximum amount of deduction is 30,000, whether the loan has been used for the repair purpose, renewal purpose, reconstruction purpose, whatever it may be, right? And that if you have taken self occupied house or the let out house property. But the problem is, or the main construct area, that if you have taken loan after 1499, so that if you have taken loan after 1499, there are several conditions. You can see I have written here the asterisk sign, and this condition has been written here. That is, acquisition of or construction must be completed within 5 years from the date of financial year in which the loan was borrowed, and a certificate from the lender specifying interest must be provided. Now, that what does it mean? It actually mean in a very simple terms that your construction that you have loan taken, that is you have taken a loan after 1499, and after this 1499, that your construction must have to be completed within 5 years from the date of the taking of the loan, because up to 5 years you will get the benefit. Now, there what type of the benefit? There is a two type of interest, that is called pre-construction interest and post-construction interest. We will see in our next slide it is, but for the time being, for your better understanding, that is, if the loan has been taken after 1499, it should be completed within the 5 year from the financial year of the taking of the loan. Now, that this is the condition, but actually what is the maximum amount that you are supposed to get? That is, the maximum limit is rupees 2 lakh. Now, that when the 2 lakh will be applicable, that is if your loan has been taken for the reconstruction purpose. If your loan has been taken for the reconstruction purpose and the loan is after 1499, we will get maximum 2 lakh, whether it is a self occupied or the let out house property. But there are another provision, that is when there is a 30,000 maximum amount of deduction. Now, that when it is maximum amount of deduction, that if the condition doesn't meet, if the condition doesn't meet, that is if your loan is considered after 1499, but it will be taken as a repair or renovation purpose, then the maximum 30,000 will get the benefit, right? So just for this slide we will see there is a before 1499 and the after 1499. Before 1499 we will get the maximum deduction of 30,000. After 1499 there are two several provision, and that under the condition that the house has been completed within the 5 years from the taking of the loan. And the second one is the if this is, that is, the loan has been taken for the use of the reconstruction purpose, you will get the maximum 2 lakh, and the loan has been taken for the repair purpose, you will get the maximum 30,000, right? So the detail, so that this is the total interest valuation. Now, just we have discussed here, that is pre-construction and post-construction interest. That is under section 24b, it is actually the composite of pre and post-construction. Now, that what is this pre-construction? That is interest pertaining to the financial year completion under the construction or the acquisition from house property. So that whatever be the interest, it will be severally divided into 5 equal financial year, that is 5 equal installment. So suppose your pre-construction interest is rupees 1 lakh, so 1 lakh divided by 5. Why 5? Because as per the income tax act, that is loan has been taken, and that the acquisition or construction should have been completed within the 5 years for the financial year date of loan taken. So that if your total pre-construction interest is rupees 1 lakh, so that 1 lakh divided by 5 year, that is for each year we will get 20,000 benefit. So that this is called pre-construction, but this benefit will be available up to 5 years. Next is the post-construction interest, and post-construction interest means interest pertaining to financial year fully allowed until and unless the loan has been repaid. So the loan has been repaid means that is until and unless you are supposed to paying off the total amount of loan, right? So that pre-construction plus post-construction, we will get interest under section 24b. Now the provision of areas of unrealized rate. So that under the income tax act there are several provision. Now that what are the provision? Unrealized rent, if you supposed to have in a one particular financial year, now it is taxable in the date of receipt or realization. Suppose there is an unrealized rent for financial year 2001 2002, but you recovered this unrealized rent in 2024-25 financial year. So on the date of recovery, that is 2024-25, you will get the total taxation, or that the total taxation scenario. So this taxation, that is unrealized rent, subject to considered as a realization value and the realization in a particular financial year. And the standard deduction is allowed from this unrealized rent is 30%. So that it is taxable if the assessee is not the owner. If the assessee if not the owner for the date of realization, suppose in case of date of occurring of unrealized rent, that is the assessee was owner, but in date of realization assessee will not be owner, even if this will be taxable because it is pertaining to the that relevant financial year. Now this standard deduction, as we have already discussed, that is the in case of self occupied house property, or that the let out house property, it is called SOP or the LOP. So maximum it is 2 lakh if the loan taken for the purchase or construction, and for self occupied or let out it will be 30,000, that is if the loan is taken for repair or renovation. Now the rules that just I have already discussed, the total interest amount, that is pre-construction plus post-construction. This current year interest is called post-construction period, and the pre-construction means that is pre-construction, that is from the date of borrowing. You can see in my lower portion of the site, that is from the date of borrowing up to the period end, that is called the 31st of March, or the date of repayment of loan, whichever is lower. Suppose my date of repayment of loan is 15th of October. My date of repayment of loan is 15th of October. So 31st of March or 15th of October, whichever is lower, that is 15, that is 31st of March. So that we will take the pre-construction period, that is from the date of loan taken up to 31st March of the relevant financial year. So that this is pre-construction divided by 5. 5 means the total 5 financial year. So that after that we will get the total interest on loan under income from house property. So just you see one sum. I hope up to this is a clear scenario, that is the interest on housing loan under section 24b. So Mr. A took a loan of rupees 12 lakh at the rate of 10% per annum on 1/10/2021 for construction of the houses. Now here are two pertaining situation. One is called construction. Please underline this word, that is construction, and this date 1/10/2021, so that it is before 1/4/2019 or that after, it will be after 1/4/2019, right? And this is construction, that is no repair, no renovation. He repaid of rupees 2 lakh as the loan of 1/1/2023 before construction. Construction was completed on 30th of June 2024. So you need to calculate interest of deduction under section 24B for the assessment year 25-26. So the related to financial year 24-25. Now your step number one, I am just showing the elaborately the step by step calculation. Okay? So that identify the pre-construction period. So from the date of loan taken, you can see that is borrowing is 1/10/2021 and the end date is 31st of March 2024. Why this 31st of March, my dear students? Up to this we have taken the scenario that is 31st of March or June 2024, whichever is lower. Sir, what does it mean? Probably we will have a question. Sir, why you have taken 31st of March 2024 as the end date? Because you see the construction completed on 30th of June, and before 30th of June 2024, the earlier date was 31st of March. And then as per the provision of Income Tax Act, that is 31st of March or the date of construction completed, whichever is lower. Now you can see the 31st of March or the date of construction completed is 30th of June. So the lower is 31st of March. So that our pre-construction period is 1/10/2021 to 31st of March 2024. Now step number 2, calculation of pre-construction interest. So in first year, that is 1/10/21 to 31st of March 23, I am actually breaking down this calculation, right, for your better understanding. So that what is the amount? That is rupees 12 lakh. So that what is the rate of interest? That is called 10%. So 12 lakh into 10% into 6 months, because October, November, December, January, February, March. So that there will be 6 months, so that the amount is 60,000. So that it is the first one, right? So that in case of second one, that is 1/4/2022 to 31st of March to 31st of December 2022. Why this 31st of December? Because you can see he has paid rupees 2 lakh amount of loan on 1/1/23. That is, it is called principal payment. The total amount of principal of the loan is rupees 12 lakhs, and on 1/1/23 he has paid 2 lakh out of 12 lakhs, so that it will be 10th so that it will be 1/4/2022 to 31st of March 2020, sorry, 31st of December 2022. So that how many months? It will be 9 months. So that 12 lakh into 10% into 9 months, that is rupees 90,000. Now from 1/1/23 to 31st of March 23, that is, I am actually separating these 12 months into two pertaining area. That is for the 9 months calculation, another one the 3 months calculation. So that it is 10,000. So 10,000 into 10 months into 3 by 12, that is 25,000. So that why it is 10 lakh? Because the 2 lakh has already been paid off in 1/1/23. So the remaining amount is 12 lakh minus 2 lakh, that is rupees 10 lakh. And the last one, that is the 1/4/23 to 31st of March 24. It is actually the 12 months. So 10 lakh into, so that 10 lakh into 12%, 12 lakh into 10% into the 1 year, that is rupees 1 lakh. So the total amount is 75,000, that is 2 lakh 75. So that these 2 lakh 75 divided by 5, that is 55,000. And the loan has been still remain the outstanding So just you see the step number 3, that is calculator of the current year interest. So the remaining is the 10 lakh. So 10 lakh into 10%, that is rupees 1 lakh. So the total amount is 1 lakh plus 55, that is 1 lakh 55,000. And this, and the maximum limit is how much? Maximum limit is 2 lakh, because the house is used for the construction purpose, and the maximum limit is 2 lakh, and the amount is 1 lakh say 55,000. So entire amount will be deduction under section 24b, right? So that this is the simple step of calculation, that is the interest on housing loan. आगे चले. So this is just a scenario that what the calculation has been taken, that is the total loan after the reconstruction, total the repaid loan, as well as the various type of the housing loan. Now the same now the same thing, just I have taken the 1 second. That is, Mr. X is took a loan of 15 lakhs of 12% per annum of 1721. He paid rupees 3 lakh for before construction. Construction completed on 39. He further repaid. Here are two repaid value. One is rupees 3 lakh. This is the difference of the previous sum. One is the rupees 3 lakh on 31st of March, and second is 2 lakh of 11024. That is mid-year after construction. So calculate the rate of interest. Sorry, calculate the total interest. So same way of process and calculation, that is calculation of total pre-construction interest, that is 1721st to 31st of March 24. You will see the total calculation is 4,23,000. So this 4,23,000 divided by 5, it is 84,600. This is called pre-construction. And the post-construction period, for the time being, it is called 12 lakhs, because it has been paid the uh, of the of 11024, that is 12 lakh. So 12 lakh into 12% into 6 by 12, because April, May, June, July, August, September, that is 6 months, that is 6 by 12. And the second one is 11024 to 31st of March 25, that is 10 lakh. So 10 lakh into 12% into 6 by 12, so the total is 1 lakh 32. So 1 lakh 32 plus 84,600, so it will be 2,16,600. But you know what, that maximum amount of deduction of rupees 2 lakh, that is maximum amount of deduction of rupees 2 lakh if it is a construction, if it is a construction of the house. So this 2,16,600, which is a maximum limit of rupees 2 lakh. So that here interest on housing loan is rupees 2 lakh amount, though the amount is 2,16,600, but the total uh, deductible amount is rupees 2 lakh. So what is the deviation between the first sum and the second sum? The deviation of first sum and second sum, that is, there is a one the periodical payment, here are two periodical payment, that is the mid year after the construction. Now another sum, that is Mr. M is the owner of three houses. Actually here I am considering two houses, so just you are considering here two houses, because the house number 3 I am not supposed to consider here, right? So that Mr. M is owner of two houses situated in Durgapur, and the particulars of the previous year are given below. You can see the construction completion date is given. Next is the layout for the residence and the for the owner residence. Next is the municipal value is there, rent received is there, fair rent is there, interest on loan is there, municipal tax is there, and the vacancy period is there. So first house is for the layout purpose, and second house is for the self occupied purpose. I repeat this once again. Just first house is for the layout purpose, and second one is the self occupied purpose. So that we are having various information: fair rent, rent received, municipal value, interest on housing loan, municipal taxes, as well as the vacancy period. ठीक है स्टूडेंट्स, तो फिर आगे चलते हैं. So just a computation value, so that as you can see, that is for the layout purpose, the first house, that is house number 1, the gross annual value, that is rupees 1 lakh. Now how this 1 lakh will be calculated, I will prepare the note number 1 for you. You can see the note number 1, so that this is just my working note. That is the expectation of gross annual value, that is expected rent. I will I will just make an underline here. Expected rent, that is higher of municipal value and fair rent. Now the municipal value is 1 lakh, fair rent is 1 lakh 10,400. So that the what is the value? That is 1 lakh 10,400. That is the higher value. Actual rent received is rupees 1 lakh. So this 1 lakh 10,400 and the actual rent received. So if the actual rent is lower than the expected rent solely due to vacancy, please underline this word solely, the actual rent received is greater than the gross annual value. So that it will be rupees 1 lakh. Now, in case of the self-occupied value, now that what is the self-occupied? That is the net annual value will be nil, right? So that you can see as per the gross annual value, the self-occupied, that is the net annual value will be nil. So that I hope the first step is clear. That is in case of house number one, that is the gross annual value of rupees 1 lakh, and the net annual value and the gross annual value for the self-occupied house, it is nil. Now you see the actual rent. Now there are 2 months of vacancy period. So if 10,000 per month is the per month the rental calculation, so the 10,000 into 2, that is rupees 20,000. So this 1 lakh 20 minus 20,000, it will get of rupees 1 lakh. That is called actual rent received. So just you can see, that is the gross annual value minus municipal taxes. So that the gross annual value we will consider of rupees 1 lakh. Now, in case of the no standard deduction, you see the house number 2. I am just comparing. No standard deduction will be allowed, but the interest on loan, which is to be deductible 30,000 or 2 lakh, depending on the condition. Here 12,500 is deducted because it has mentioned in the question. You can see it has mentioned in the question, that is rupees 12,500, right? So that these 12,500 has been deducted. So now from the gross annual value, we will deduct the municipal taxes, and the municipal taxes is 10% of municipal value. So that this 10% of municipal value, that is 1 lakh into 10%, that is rupees 2 lakh. Now here one thing, the house is situated in Durgapur. Why I am highlighting this Durgapur? Because it is a non-metro city. If it is a metro city, then the calculation will be different. That will be the 90% of the gross and gross municipal value into municipal tax rate, if it is a metro city. But if it is a not metro city, that the entire municipal value is there, so that just we make the percentage, so that 1 lakh into 10%, that is rupees 1 lakh. Sorry, 1 lakh into 10%, that is rupees 10,000. So that 1 lakh minus 10, so that is our net annual value is rupees 90,000. From this 90,000, we will get the standard deduction of 27,000, and the interest on loan just given in the question 12,000, so that it will be there as 51,000. Now the second is that is the net annual value will be nil, and the standard deduction will be nil, but the interest on housing loan is 12,500. So this is the loss from house property, that is 12,500. So what will be the net income? 51,000 minus 12,500. So the net income from house property is 38,500. So that this is the entire scenario of the calculation of the income from house property under this condition. आगे चले. Now this is the another sum. Now I am just highlighting the main portion of the sum, right? So the assessee, the name of the assessee is Sri Showman Panda. Status is the resident and the ordinary resident in India. Now this resident and ordinary resident, you will find the residential status under the income tax. And my dear students, you know very well there are three types of the condition. That is whether you are considering resident and ordinary resident, whether you are considering resident but not ordinary resident, or that whether you are considering the non-resident. So your previous year is 24-25 and the assessment year is 25-26. You see the house number 1, that is situated in Kolkata, house number 2 situated in Durgapur. Date of completion in case of house number 1, it is 1/1/1998, and the second one is 1/4/2008. Now, how the house has been used? It has been let out but self-occupied for the part of the year. What does it mean? Now, it is not necessary that the house has entirely let out for the entire financial year, or house has been self-occupied for the entire financial year. It can be a partial way. Suppose if there is a 12 months, so 9 months is let out, and the 3 months it is being self occupied. And the house number 2 is the entirely let out for the financial year. There is a municipal value, there is a local taxes, there is a rent receipt of 8 months, and the land revenue is there, and the collection charges including the foreign exchange conversion expenses uh, in case of house number 2. So that from this you need to calculate that is what is the entire income from house property of Sri Showman Panda. So just you see the solution. So that in first case you will see the one by one. In case of house number 1, that is the expected rent. That is the expected rent is 50,000 based on the municipal value. Now there's how this 50,000 will be calculated. Just we have uttered several times. There is higher of fair rent and municipal value, but restricted to standard rent. And then after that we will deduct that is the vacancy period, right? Now you can see for the house number 1, as you can see, since the house was let out for the part of this year and self occupied for the rest, it will be treated as a let out property. Please do underline this word. There is a partial let out situation, there is a partial self occupied situation. If the house has been let out for the part of the financial year and self occupied for the rest, it has been treated as a let out house property. So the gross annual value is the higher of expected rent for full year or the actual rent received. So my actual rent received is rupees 36,000, but it will be the expected rent is 50,000. So that what will be the gross annual value? That is 50,000. So from this 50,000 you need to deduct that is municipal taxes. After this deduction we will see it is 46,000. And then after that the house number, I am only talking about house number 1 now, that is 30% of NAV, that is 30% of 46,000. And the interest on borrowed capital it is nil. So income from house property, that is in case of house number 1 it is 32,200. Now just to come the house number 2, which is to be a Durgapur situation. So that in house number 2 actually we will see that is the expected rent is 40,000, you can see, and that the actual rent is 48,000. So that which is to be higher one, that is 48,000. So this 48,000, from this we will deduct that is 30,000, so that it will get 45,000. After that we will deduct that is the standard deduction, and then we will get the 31,500. So that interest on house number, that is the interest on housing loan for in case of house number 2 it will be nil. So that we will see the in case of house number 1, that is it will be the income 32,200, and for house number 2 it is 31,500. So that it will be 63,700, right? And the admissible expenses, that is called inadmissible costs such as land and revenue and the collection charges are not be deductible under income tax act. That is only we need to cover 30% of standard deduction intend to cover all repair and maintenance cost. So that whatever be the repair cost, whatever be the maintenance cost, whatever be the collection charges, we will we will include in 30% of deduction. There is no separate or legal provision that is land revenue or the collection charges in this case. आगे चले my dear students. Now consider this scenario, that is Mr. S is an owner of 3 houses, that is house number 1, house number 2 and house number 3. From the date of completion it is 1191. From the date of completion is 1/1/2001 in case of house number 2, and house number 3 is 1/4/19. Now how this house has been used? Now in case of uh, house number 1 it will be a residential proper, just a self occupied. In house number 2 half or 50% is self occupied for business, and 50% gives to manager for the business. Matlab 50% self occupied for business, this is for owner's business, this is for owner's business, right? And the 50% give it to manager for business, and house number 3 let out for business purpose. And there are several calculations, that is gross municipal value is given, fair rent is given, standard rent is given, rent receivable is there, vacancy period is given, unrealized rent is given, municipal taxes for the concurrent year is given, area of taxation is given, legal expenses for house number 3 is given, ground rent is given, fire insurance premium is given, as well as the interest on borrowed capital is given. So that we need to consider under income from house property. So just to consider first house number 1. As you can see, the house number 1, it is for the let out purpose or the residential purpose. So house number 1 is completely for the self occupied purpose, that is the let out purpose. That is, it is not self occupied, it is for the let out purpose, right? So the thing is that in case of house number 1, that is the gross municipal value is there. So from this gross municipal value, we need to consider fair rent. So that fair rent or the municipal value, whichever is higher but restricted to standard rate, that is 25,000. That the annual rent receivable is 35,000. So 35 or 25, whichever is higher, that is 35,000. And municipal taxes paid is 36,000. So that there will be a negative net annual value is 1000, and the standard deduction is negative as the NAV is the negative value. So that interest on housing loan is 3000. So 3000 plus 1000, that will be the loss from house property 1, that is 4000, right? So that just we are making up the calculation, that is loss from house property 1, that is rupees 4000. Now in case of house number 2, it is for the business purpose, right? Because 50% self occupied for business and 50% given to the manager for business purpose. So the entire property, you can see, if a property is used the owner's own business or profession, then it will be not taxable under income from house property. Instead, the expenses of depreciation and the for the pertaining to building can be claimed as a profits and gains from business and profession. So the house number 2 is used for entirely business, that is half is owned, that is the half for the manager business purpose. So the entire business, that is the entire income from house property will be nil. So I repeat this once again, if the house is used for the business purpose, it will be not considered under income from house property, rather than it will be considered under income from PGBP, that is profits and gains of business and profession. Now house number 3, it is for the commercial purpose, that is for the let out case. So that we can see, that is the gross municipal value is there, fair rent is there. So that higher of gross municipal value and fair rent, but there is no standard rent. So that the gross annual value is 36,000. Why this 36,000? Because there is an unrealized rent of rupees 12,000. So that 48 minus 12, it is 36,000. So that the 36 or 40, so that this 30 or 46, that is whichever is higher, that is 40,000. So 40,000 minus municipal tax and minus two subsequent deduction, that is the interest on housing loan and the standard deduction, which is 30% of NAV as well as the repair. So that it will be 17,400. So in first case, that is in first house number 1, it is the negative 4,000, that is the loss from house property. Income from house number 2, it will be considered as a income from profits and gains from business and profession. And in third one, that is the 17,400. So the entire will be 13,400, that is our income from house property. So just I have made the several types of the provision, that is municipal taxes, that is you can deduct the 8,000 of the area, unrealized rent, and so on, right? Now we are moving to the another portion. So calculation, uh, now we are moving to the another portion, that is income from co-owned house property. Now what do you mean by this co-owned house property? There are different types of ownership. I have told that when we have started our student discussion, that there is a co-ownership, partial ownership, or deemed to be ownership, right? Now, under Section 26 of Income Tax Act of 1961, it has been covered. That is, if we are talking about self-occupied, that each co-owner annual value is nil when they opting or that when they are opting old tax regime. So that each co-owner annual value is nil, the entire deduction will under interest on housing loan it will be rupees 2 lakh. But under the new taxation regime, that is annual value is nil, but there is a question here, as you can see, that is no deduction for interest is allowed for self occupied house property, right? So that if it is only the let out it will be allowed, if it is a self occupied it will does not be allowed. And the main thing is that each co-owner annual value is nil when I am talking about co-owner of the house property, right? Let out property, that is, in case of let out, income is calculated as one unit. Income is calculated as one unit and then split among the co-owner based on the share. Suppose the co-ownership is or that co-ownership is 60% 40%. Suppose there are two co-owners, Mr. A and Mr. B. So then Mr. A is apportionately 60%, Mr. B is 40%. So the entire income is calculated about 100%. After that it will be divided in 60 and 40. Yeah, this is for the opting of old taxation regime. But when I am talking about the new tax regime, same as old, so that whatever we have calculated under income, that is the old taxation, it will be same as a new taxation. That is, income is calculated as a whole and then apportioned as the share of owner. Next is the interest benefit, that is rupees 2 lakh is apply each co-owner separately. That is, the interest on housing loan, it is rupees 2 lakh for one co-owner, it is rupees 2 lakh for another owner. That is the maximum limit of rupees 4 lakh under the old taxation regime. But in case of the new taxation regime, self-occupied is not being allowable, but only the let out will be available, but restricted to the house property only. But restricted to the house property head, that is only the let out portion will be available. So that this is called the co-ownership or the partial ownership value. Now considered as a deemed ownership. So that who is a deemed owner? So the deemed owner who has to pay tax. Suppose in case of the first one, that is transferred to spouse. So that who is a deemed owner? Those person who is transferring, that is called transferer. For example, husband is transferring his house to his wife. That is, the husband is called as a transferor or the deemed owner. There are some exception case also. You can see, if the transfer has been done with an agreement or leave apart, that is for an adequate pay of consideration. So the first is the transfer by husband to wife or transferred by wife to husband. That is in spouse situation. That is the husband or wife, that is spouse, is considered as a deemed owner, those who are transferring the value. But the exception case is, that is if there is in an adequate pay of consideration, then this will be not considered as a deemed owner. Rather than the name who are in a transferee, it will be considered as a transferable value. Now the second is the transfer if it is a minor child. So transfer to the minor child, suppose if it is father, that is father is transferring to its minor child. So the father is considered as a deemed owner. If the child is a minor or married daughter, so this is an exception case. If the child is a minor or the married daughter, if it is an exception case. Second is the holder of the estate, that is the impartiable estate. This is not applicable under the exception that the holder is always treated as the owner. Cooperative society flat and the member, that is allotee, it is not applicable even the society hold the entire title deed. So if I am talking about the long term lease, then the lease agreement, if it is greater than 12 years, then it will be applicable. If the lease is not greater than 1 year, then this is the exception case, that the deed ownership will not be considered. So just I am recovering here, that is exception of the deemed ownership, that is transfer to the spouse, that is transfer is made in connection of the living apart. So the transferee spouse is taxed on the based on the income. Transfer to the minor child, if the property is transferred to the minor child or the married daughter, so the daughter is treated as the owner in case of normal clubbing of income. Now there are another provision under income tax act, that is clubbing of income, that the whether is transferring value will be clubbed under the which heads of income. And the next is the leasehold right, that is the rights are being acquired from the lease, that is month to month, which is equal to one particular year. Now up to this discussion we are getting that how to income or that how to compute income from house property. But suppose if there is any loss from house property, as our several discussion we will see, that is there are some loss from house property. So how this loss will be adjusted or carry forward? So there are some provisions under income tax act, my dear students. So loss from house property can be set off under same head, that is under income from house property or any other heads of income in a same or relevant financial year. So what does it mean? It means that is loss from house property shall be set off again income from house property. Suppose I am incurring a loss from house number 1 of rupees 4,000. At the same time I am incurring an income from house number 2 of rupees 9,000. So these 4,000 can be set off against 9,000. But my dear students, is it really practical situation that always I am having two or that more than one house? Suppose I am having only one house, and that house is incurring becoming a losses. So how this loss will be treatment? So if it is a treatment under the same head, that it is okay. If it is not, then it will be considered up to the carry forward up to 8 years. If the assessee doesn't have other heads of income, because if there is any salary provision is there, if there is any non-speculative income is there, if there is any non-specified income under the income from other sources is there, so that either we will adjust the same head. If it is not, then we will consider the intra head. If it is not, it will be considered up to 8 relevant assessment here. So just I have mentioned here that thereafter if the loss of the remaining is being unadjusted, such unadjusted loss can be carried forward or set off up to the 8 assessment year against the income from house property. So these are the deduction. Just I am synopsis that what we have discussed in our today's lecture session. There is the maximum deduction of rupees 2 lakh. This is for you. Remember, this is actually the one shot at a glance, right? This is the maximum condition that the loan must be acquired after 1499. The loan is taken for construction or acquisition purpose. So the maximum of rupees 2 lakh, and the lower limit is 30,000 if the loan is taken after 1499, and that it will be taken for repair, renewal, as well as the reconstruction, as well as the several type of the renovation purpose. It will get maximum 30,000. If it is longer than 5 years, it will get maximum of rupees 2 lakh. So just I am talking about the set off and carry forward. There is the two types of, that is the old and new taxation. That is the intra head set off, that is the loss from house property can be set off the income from house property without any limit, and that the under the new taxation regime, that is it will be allowed, that is loss from one property can be set off the income from other. In case of the intra head allowed up to 2 lakhs. In case of the new taxation regime, uh, there is no maximum limit, right? And the carry forward under the old and new, it will be under the old and old taxation, that is the carry forward up to the 8 assessment year. But in case of self occupied under the new taxation, it will be not be there, the provision will not satisfy it. In case of it will be let out purpose, it will be carry forward up to 8 years. So that the conditions of the carry forward, that is ITR, must have to be filed on and before due date, that is under section 139 subsection 1. So this is all about my slide. So over to coordinating, sir.
Thank you so
Sir,
much, sir.
yes,
It was really great session, and I hope all the students have got the knowledge about the income from house property. And it was really great session from you again. Thank you so much, sir, for your valuable contribution and excellent delivery of this lecture. Thank you so much, sir. I hope you will
thank you, thank you.
contribute in our special lecture in future also. Thank you so much, sir.
Yes, yes, my pleasure, sir.
Thank you so much, sir. So with this, we are concluding today's session. Thank you
Okay,
so much to all.